Okay, so Novo Nordisk just dropped its latest earnings report, and it's a fascinating story. On one hand, you have this incredible, explosive growth. On the other, you have some pretty immense strategic pain. Understanding this quarter is absolutely crucial because it could really define where the company is headed for years to come.
Look, if you're an investor trying to cut through all the noise, you can pretty much ignore everything else. This entire complex report really boils down to just three numbers. These three figures tell you exactly where the company is right now and, maybe more importantly, where it's going.
First up is 15%. That's the top-line sales growth for the first 9 months. And this is at constant exchange rate, so it's the clean number, without any currency weirdness. It tells you one simple thing. The underlying demand for their products is incredibly strong.
Second number, 41%. That is the staggering growth in their Obesity Care segment. This isn't just another product line, folks. This is the rocket fuel for the entire company. It's the powerhouse that's reshaping their whole future.
And third, here's the pain part. A massive, one-off restructuring charge of 9 billion Danish Krone. This is the number that absolutely hammered their profits this quarter. But here's the kicker. This wasn't an accident. This was a deliberate and painful strategic move.
So, you've got this amazing growth on one hand and this giant cost on the other. How do you make sense of that? This is the real tension at the core of the report, so let's dig in and break it down.
And this right here tells the whole story. The official number you see is 10% profit growth. Okay, fine, but once you pull out that one-time restructuring cost, bam, the real underlying operational growth was actually a much more impressive 21%. This proves the core business is performing exceptionally well.
So we know the business is fundamentally strong, but where exactly is all that power coming from? Well, the answer couldn't be clearer. It's really all about one specific part of the business.
I mean, just look at this. The diabetes and obesity care segment isn't just the main part of the business. It is the business, practically. It makes up 94% of the sales mix, completely dwarfing everything else. This is the financial engine of the entire company.
And what we're seeing here is a classic changing of the guard happening in real time. Wegovy's incredible 54% jump isn't just new business. It's literally eating the lunch of their older drugs like Victoza and Saxenda. This is a deliberate strategic replacement, consolidating their market power into their newest blockbuster.
And don't think for a second this is just an American thing. No way. The growth is remarkably consistent, rock solid across the board. Both the US and international operations are putting up these powerful double-digit numbers. This is a truly global phenomenon.
Okay, so that brings us back to that huge 9 billion kroner charge. It's so important to get this right. This wasn't a loss, it was an investment. A deliberate and, yes, painful investment in the company's future.
So what are they doing? They're basically doing a full-on company-wide transformation. They're simplifying the whole organization, which includes cutting about 9,000 jobs globally. The goal here is to get leaner, to move faster, and to pour every available resource into those massive growth opportunities we just talked about.
And you don't have to take my word for it. The president and CEO, Mike Dustar, said it himself. When he says they aim to accelerate on all fronts, he's basically saying, we're taking a big hit now so we can run much, much faster later. It's a classic short-term pain for long-term gain strategy.
So where did that 9 billion kroner actually go? Well, about 5 billion went to severance packages, and another 4 billion was for asset impairments, writing down the value of older assets. In Wall Street speak, this is called clearing the decks. They're getting rid of the old to make way for the new.
All right, so they've cleaned house. Now where are they putting their money for future growth? It looks like a two-pronged attack, building new things from within and buying growth from the outside. First, let's look inside. Their R&D pipeline is absolutely humming. Cadrelintide, which could be their next big weight loss drug, is moving into phase 3. That's huge. They also just got Wegovy approved for MASH, a massive new market. And they're still pushing forward in rare diseases. Plus, they've already started early trials on what they're calling a triple agonist. That's the next generation. And they're not just building, they're buying. They're dropping $4.7 billion on Akero Therapeutics. Why? To get their hands on a potential best-in-class treatment for MASH, which, you guessed it, is a multi-billion-dollar market often tied directly to obesity. It's a perfect strategic fit.
But they're not putting all their eggs in one basket. They're also making sure their other segments have growth drivers. They've acquired a promising rare disease asset from Omeros. This shows they're still committed to building out other parts of the business for that long-term stability.
Okay, that all sounds pretty great, but let's be real, it's not all smooth sailing. No investment is. What are the big risks here? What could actually go wrong?
You really have to keep your eye on three things. First, competition is heating up fast. The whole GLP-1 space is getting very crowded. Second, pricing pressure is coming from the US government starting in 2027. And third, there's this nagging problem of illegal compounding, basically knockoff versions of their drugs that are siphoning off sales.
But even with all that on the horizon, management is standing firm. They've reaffirmed their guidance. They're essentially saying, yeah, we see the challenges, but the global demand for our drugs is so massive, we're confident we can power right through it.
So, here's the bottom line. Novo Nordisk is taking a lot of pain right now, spending billions and cutting jobs, all to streamline the company and aggressively fund the future. And that leaves you, the investor, with one giant question. Was this painful move a masterstroke to solidify its market throne for the next decade, or was it a hugely expensive gamble in the face of growing threats?